Um, so we got Rick Brown from Evesham Mortgage, and we have Brian Homowitz with New Cross Country now. So we wanted to get these guys on with us today to kind of give a state of the mortgage union, to see what's going on in our world today. There's always different types of questions everybody has. The biggest one, not just from agents, but from the public, is what the hell's going on with our economy, our market. We can't get that 2.75% interest rate anymore. Well, maybe we can. I don't know if maybe Brian and Rick can figure out how to get it for us, but so we just kind of wanted to talk to you guys today. Maybe you guys could take a couple of minutes each and just kind of introduce yourselves, and then we'll roll from there. Brian, you want to start?
Sure. Good morning, everybody. As Gene said, Brian Homowitz with Cross Country Mortgage. Been in the mortgage industry this year actually marks 20 years, 19 of which I was actually with Wells Fargo. And as of February of last year is when I made the move from Wells Fargo to Cross Country Mortgage. So been a long time, I guess I'd say, in the industry, kind of been through a bunch of different cycles, right? From the early 2000s to the economic crisis of 08. Now, I guess we'll call it to the pandemic era. So, constantly, learning, right? Constantly learning, constantly going through new economies and new issues and new ways to kind of do business. So, yeah, it's been a pretty crazy 24 months, right? As a lot of us can attest to. Yeah, no, happy to be on the call. I'll get into it a little further as we dive in. Just do a quick intro. I'll roll it over to Rick.
Hey, Rick. Good morning. Give us a little
good
intro.
Morning, everyone. Thanks for having us on. I'm honored to be on a panel with Brian. I've been lucky enough over the last year or so to meet with Brian and discuss things with him, and he's a top-notch loan officer and mortgage executive. So I'm happy about that. So I'm the owner of Evesham Mortgage. I actually opened in 2008. I opened the company in 2008 with my sister-in-law, who was a processor. We're an independent mortgage banker. I currently have 51 employees now. We have 3 different branches. We're licensed in Pennsylvania, New Jersey, Florida, Illinois, Tennessee, South Carolina, North Carolina, Michigan, and Delaware, and Connecticut are coming. What we try to do is we're a realtor referral only source. I've been doing this for 25 years, and I gear it to try to make sure that we can give our real estate agents all the weapons to go to battle. And in today's market, we need as many weapons as we could possibly have. So got a couple cool things happening here that I'm going to look forward to introducing to you guys when you're ready for it. Also give you a little state of what else is going on around here, right? There's what we call a non-QM world that's sprouting up here with regards to different types of mortgages that are available. So I just kind of follow Gene's lead, and when you want to hear about a couple of neat products, we'll bring it up and you let me know.
Well, I mean, yeah, we're going to kind of leave this kind of very easy flow, and we just kind of want to let you guys kind of take the reins on this and kind of bounce off of each other, what you guys have going on in your own worlds, from 2 different companies, what's working. The biggest challenge, and I can speak on behalf of everyone here, the biggest challenge right now for many agents that are working with buyers is that, not every buyer that we have is going to be putting in cash offers. Not every buyer that we have, can do 20% down. And, we kind of want, we feel like, there should be like, no man/woman left behind. And we feel like some people just can't get a home because they're putting in, 10, 15 offers and they're not getting
You're
home.
breaking up a little, Gene.
Oh shit, I'm sorry. Is that better?
I got you.
Okay.
You're fine on my end, Gene.
It was fine here too.
Yeah, thanks, Christian,
So,
for ruining my talk.
Yeah, so Gene, so you're exactly right. And one of the things that we just rolled out a couple weeks ago, and I was waiting for this call, is we rolled out a program where we're going to guarantee closings within 15 days of attorney review being over. And then by the time, what we're guaranteeing, the reason that's important is not only are we going to guarantee closings within 15 days, we're going to issue full mortgage approvals. So when you're going in for your offer, you don't have a pre-approval. You can't issue a commitment in New Jersey without an appraisal, but you can issue a loan approval. So by the time that you go for your offer, we're going to have already underwritten the file, already run the file through the underwriting systems, and you're going to submit your offer with a mortgage approval, and we can close in as quick as 15 days guaranteed, or we're going to roll out a $2,500 lender credit. Now, that a lot of communication has to happen for that, right? Especially in North Jersey with the attorneys. We have to make sure that the attorneys and title are going to get us title within 7 days. I've already set up arrangements with all of our appraisals that we're going to have appraisals within 7 days. So it kind of gives you a head up when you go in for that offer, because it pretty much is, even though it's not cash, it pretty much is cash because you already have a loan and your borrower already has that loan.
So how do you, so Rick, how do you prep, the agents and the borrowers? Because, some of these buyers, they're kind of lackadaisy also, which obviously they can't be in this market, which also comes down to obviously the consultation happening, between the agent and the buyer right at the get-go. But I can, I'm sure there's people here right now that will probably nod their head or give us a thumbs up that they have some buyers that are like, well, yeah, I want to go see the house first, and if I like it, then I'm going to go talk to my lender. I mean, that's still happening, and it can't. It's impossible.
Sure, yeah, and it's the biggest part of the initial consultation. And if you talk to 10 people, and Brian would wholeheartedly agree, if you talk to 10 people, there's 7 that are legitimate, want to buy, and then there's 3 that just kind of say, well, maybe I want to list my house, I'm not really sure. But the real legitimate buyers that in our initial consultation, when we're sitting there and we ask for tax returns, W-2s, and pay stubs, if they have it home, they don't give them to us. It's just the communication between us and the realtor, right? Christian refers a deal over, and the guy wants to go see $1 million house and wants to put $500,000 down, but doesn't want to give us bank statements, pay stubs, or W-2s or tax returns. It's kind of a red flashing light. Like, hey, what do you mean? You want to go look at $1 million house? You tell us you have $500,000, but you don't want to talk to our lender who's going to offer you a free approval to get you this house. And it's just, the biggest thing is it's the communication and relationship between the lender and the realtor, having legit conversations about what's going on with that individual buyer.
I think, Rick and Brian, question for both of you guys. So the problem that a lot of us are having is that
trying to get people to take care.
anybody that's getting a mortgage, right, if they're putting down less than 20%, I'd say 95% of those people are being asked to waive the mortgage, right, the appraisal. So it's tough, right? Like, how do you guys combat with that? And what suggestions do you guys have for those buyers that are putting down 15% and have to waive an appraisal? Like, what's your thoughts?
I'm sorry, before they answer, hold on one second, before they answer, can everybody please mute your phones? Because I don't have control
them all,
over
but I thought that would not be a good idea.
I don't know whoever Sherry is on this line.
Yeah, Sherry, can you mute your phone?
3 to 4 hours.
I'm not the host, so I can't mute anybody.
Who is the host? We can't.
That would be Chris Wall.
It's a cool garage.
Jerry, can you hear us?
What's that gray one? Is that a Land Rover?
Sorry, guys. We'll get this.
I can't.
Take care of it.
I can't mute her.
That's silver. It's pretty.
Yeah.
Okay.
Hey, Sherry, can you hear us?
No.
Well,
All right, so what? I'll dive in. If I hear the background noise, I'll try to get her attention. So yeah, Chris, to your point, right? If you're going to be a competitive buyer, you got to waive your appraisal contingency because everyone's so desperate. Every other buyer is going to do the same thing. I mean, I have buyers that even waive their inspection, right? Which I never thought I'd see, but nonetheless, they're doing it because they want to get the house. So. I've had buyers, for example, if you have to look at the buyer itself. If you have a buyer that's going to do 10 or 15% down, right? For example, let's just say if somebody doing 10% down, and they're going to look in a price range of $400,000 to $500,000, right? What I'm doing, as far as strategizing with the realtor is that if we're going to go over asking, okay, we got to find out from the realtor, okay, look, what is the worst case scenario that this house is going to be worth? I need you to give me that worst case number. Is it going to be 20,000, 30,000, below what they just offered? Okay. And then you just have to fine tune the lending, right? So if you're going to do 10% down, we'll maybe cut that down to maybe 3% down. Okay. Or 3.5. And then we just opened up another 7 to possibly 10 or 15% of money to make up that difference. Right.
Right.
So we just take what they're using and we just have to shuffle the money around. Now, look, there are times where the customer, a lot of people might say, yeah, but Brian, if they're putting down 5%, they don't have any more money. Right. Okay. So that might be the case, but you'd be surprised if they're finding a house that they really like. Okay. Can we get a little creative? Okay. Listen, do you have a retirement? Do you have a pension? Do you have a 401k? Do you have family? Right. You're allowed to get a gift. You can get gift funds from family members that could put you over the top. Now, I'm not going to say this is going to work every single time, but there's been multiple times where we've cut down on a down payment to make room to let the listing agent know that even if it underappraises, the borrower still qualifies, right? As long as the borrower is aware of what this worst case scenario value will be, right? And myself and Rick as the lender are going to say, look, here is our worst case scenario. Here's what you could be spending. Here could be your new mortgage payment. And here's your amount of money out of pocket. But you have enough to cover it. Do I have the green light to tell the listing agent, right? Which as of the past 3 or 4 weeks, I'm urging all my buyer's agents to allow me to speak to the listing agent. That's actually been a huge pull through where it's not a question of, hey, call my lender. It's a question of, can my lender call you? Brian pre-approved my client. Brian's my preferred lender. Rick is my preferred lender. Can I have him call you, Mr. and Mrs. Listing Agent? If I can get the yes on that and I get the listing agent on the phone when they hear it from the horse's mouth, I have now increased my buyer's offer exponentially compared to just being another guy with another pre-approval, right? So there are ways to fine tune the financing based upon the buyer. I've even had parents jump on as a co-signer, right? Because mom and dad maybe didn't want to do the gift, but they wanted a co-sign. Or the borrower, if they're at 425 and they couldn't afford 475, can mom and dad go on the loan? We'll add them as a co-signer. Now you can afford 500,000. Mom and dad have some money to toss your way. Now we can actually put more money down, less money down. And now that $20,000, $30,000, $40,000 gap has now been minimized. And now we can go in, and if there's an underappraisal, there's no risk.
And just to kind of piggyback off of Brian, because he's 100% correct. One of the things that you can actually do, so when it comes to the mortgage industry, we're kind of handcuffed to Fannie Mae and Freddie Mac, right? And they have underwriting systems. We're starting to see a lot of appraisal waivers come through with the underwriting systems. So what I've started asking some of my real estate agents to do is, if you're going to put it in offer, send me the address first. Let me run it through DU with the current situation, because if we get an appraisal waiver, we don't have to worry about any of this. I'm going to say
How do you qualify for an appraisal waiver?
It's all dependent through it's a computer system, Christian, so it's hard for us to say what regulates it. But what we find is down payment, creditworthiness, reserves, and if it's a house in a normal neighborhood, that kind of thing, not like a gray elephant.
Yeah.
We are seeing a lot of appraisal waivers, and that gets rid of all of the stress. Now you go in an offer. Now you're going in an offer with a mortgage approval, and you're telling the listing agent, hey, by the way, we already have an appraisal waiver. We don't have to worry about anything. You're even that much stronger. I mean, it's extra work for the mortgage company, but it's just what we have to do. I mean, that we have to give you guys everything so that when you're making your offer, and Brian was 100% correct. The third part of it is calling the listing agent. The listing agent will love to hear from the loan officer, hey, everything's great. With this offer, you have 32 offers, but I'm telling you, this offer is set in gold. And that's just another important thing about communicating between us and you.
Hey, Rick, there was just a quick question. While you're on that appraisal waiver, we had a quick question come in. What do you do with appraisal waivers when it comes down to VA or FHA?
Well, you're not really going to get an appraisal waiver VA. You're not going to get an appraisal waiver VA. It's just not going to happen that way. And it very rarely will be FHA. It's mainly just your conventional borrower where you can pop up an appraisal waiver.
Okay. Very cool. And then
Let me ask you guys another question, both of you guys. So a lot of my clients are asking me, like, where do you see the market going? Whether it's seller or or a buyer for that reason, like where do you guys envision rates going based on everything that's going on in the economy and all that stuff? Because some buyers, like we've talked about on this Zoom before, I have a lot of buyers that were hesitant on overpaying or buying up and spending all this money, 6 months ago. Now glad that they did because rates are even higher, right? So I'm trying to tell my buyers now, listen, I feel rates are even going higher, so you're going to be in that same position, right? So you guys think rates are going higher? What's your thoughts?
So I was out in Chicago 2 weeks ago with a roundtable with there's 5 CEOs and there was 5 capital market guys with regards to rates. And this was one of the biggest discussions we had. Because of the unrest in the world right now, it's hard to say where rates are going. But what you're going to start seeing is arms coming back. You're going to start seeing 3-1, 5-1, 7-1 arms coming back. You're going to start to see interest-only programs coming back. You might even start seeing your FHA 2-1 buy down coming back. Now, what a 2-1 buy down is the first year the rate might be 3.5, the next year it'll be 4.5, and then the rest of the term will be 5.5. So it's kind of an adjustable, but it's guaranteed where the rates are going. And you're going to start seeing those products come back because of the unrest. It's really difficult, and I'll pass it over to Brian now what his thoughts are. But because of the unrest in the world, we don't know what's going to happen. Because of the midterms coming up, we don't know what's going to happen, right? If the Republicans take over, their fiscal policy is different than what the Democratic fiscal policy is. It's the way of the world. But then what happens? What happens come November if the Republicans take the House and the Republicans take the Senate, but the Democrats still own the White House? Like, are we waiting for another 2 years of just stalemate of nothing getting done? But you are going to definitely see new interesting products coming out to help those buyers who don't qualify anymore, right? I mean, it's the case. But Brian,
what are your thoughts?
Yeah, I mean, I get the question a lot, where are rates going to go? And the one thing that I'm trying to remind my buyers, just as far as the ones that are calling me up, for example, earlier this morning, is basically what we're at is we're right now we're getting back to pre-COVID rates, right? I think a lot of people forgot 2 years is kind of a long time. You're just so used to hearing everything low. We are where the rates were before the pandemic, right? And 5 to 5.5%, although buyers don't want to hear it, it usually means the economy is a little healthier. Okay, however you want to look at it, you could really pick apart numbers and you could pick apart how many jobs have opened up, et cetera. But in general, when the economy is doing a little bit better, mortgage rates are going to go up. When the economy is doing awful, like in a global pandemic, rates are going to drop. So right now we're at pre-pandemic interest rates, and we have super high inflation. It hit 8.5% in March, which is the highest in 40 years. Inflation is the number one catalyst when it comes to mortgage rates. So they're asking me, and I'm just giving them a number because everyone wants to hear a number. No one does not want to hear a number when I talk to them, no matter how many times I try to skate around it. So I'm just basically telling everybody right now we're around 5.25. It's at least going to go up another quarter point, possibly a half a point this year, right? And then you can get into the political side of things, where Rich touched upon coming in November. What could happen then? And that's where the complete unrest comes in. But, for as long as I've been doing this, and I'm following the Treasury bill and following the mortgage-backed securities, another 0.25%, Christian, certainly seems likely from everything that I'm seeing over the next 30 days to 60 days.
A lot of what people don't realize is buyers, and even us as agents, to talk to their buyers, they should be talking to you guys, because they look at the rate as the rate, but they're not actually putting that to dollars and cents. So if someone's going to pay $500,000 for a house and they can get it at 5%, or in a month from now they're going to pay $500,000, it's going to be 5.25. Like, what does that 0.25% represent in a monthly payment? It might not be that much. It's not that big of a deal. So I think people need to be educated on really what that results to in dollars and number cents per month for them, right? I mean,
one of the things that
0.25% isn't that crazy, right?
It's not. I mean, listen, and I talk about this a lot, especially when I go visit my offices in the first quarter, when the rates started going up, and I just try to remind them, depending upon the loan size. Well, let's just say your average loan size, 300,000, 350, right? You buy a house for $450, and you put down X amount of dollars. A half a point is about $100 a month on your payment. A half of a percent on your mortgage rate is equivalent to almost $100 to $125. Now, I'm not going to get on the phone and pretend that that's not a lot of money, because $100, $125 means a lot to different people. But Mr. and Mrs. Customer, in the grand scheme of things, that's basically your homeowner's insurance, $100 to $125. I know we lost a half a point, But Chris, to your point, put it in perspective here. What does that $100 mean to you? And if that means you don't want to buy this house, so be it. But I think that when you start really just kind of, reminding them what that means to their pocket, a lot of them, at least my clients, are saying to me, okay, it's a little bit more, palatable when you break it down as far as the dollar. Now, naturally, if you're looking in a higher end market, that half a point is going to be more money. But typically, the people buying the more expensive homes might make a little bit more money, right? So it's all very relative, but it's very important, Chris. That's why I like this question, to tell them what does 5.5 mean versus 5.5, right? They just hear 5.5 and they get automatically skeptical. But when I put it down to them in writing on an email, say, here's your payment, here's where it was, here's where it went. A lot of times it doesn't sting as much, right? And that just comes back to the education piece and reminding people, why rates were low, why they are high now, and what that means to your dollar.
Right. Exactly.
Yeah, I mean, Christian, the biggest thing is, I see a lot of buyers are coming into the system because they've already been through Zillow or Realtor.com or whatever, and they're coming in with a pre-approval here and a pre-approval there. And it's really important to piggyback off of Brian, that even if you have a pre-approval, to introduce them to your preferred lender, so your preferred lender can talk them through exactly what Brian was saying. Because the majority of lenders don't do what Brian and myself do, where we educate the consumer so that if interest rates do go up, the consumer's not freaked out. I mean, when I pre-approve somebody, I pre-approve them at a rate a quarter above what the current market is. And I tell them that. I said, hey, listen, current market is 5. I'm pre-approving you at 5.25 so that you understand where the rates could possibly go. And that way the backlash isn't so hard if the rate goes up 0.5 point, Christian. It's really, really important. Not many people do that. And I know mine and Brian's philosophy are very, very similar, because we don't want that. I don't want this house anymore because rates are 0.5 point higher. That's not how it works.
Well, it's psychological for people, right? I mean, that's just the whole thing. They're looking, like you said, Brian, 2 years ago, this is where rates were. And psychologically, people are looking at it like, oh my God, rates were 3%. And now they're 5%. And I get it, but historically 5 is still a pretty low rate, right? So, but then a lot of these people have been missing out. So they've been trying to buy a house since the rates were 4, and now they can't because they keep losing out. Now they're 5. And I said to one of my clients the other day, I'm like, listen, if you've been trying to buy a house since rates were 4, and now they're 5, all we had to do was step up our game and maybe spend $20,000 more on one of those houses, and you would have got it. And that $20,000 maybe would have cost you $20, right? And it's the whole process like you're talking about. That's why I think maybe as us as agents need to get them on the phone with the right lender, and the lender needs to say, this is what it's going to be at, 5% and 5.25%. And this is what it's going to be at $450,000 and $500,000. This way, when they're making that offer, they know, oh, that extra $50,000, an extra quarter of a point is only costing me X. So they can make their offer accordingly, right?
So like, Christian, one of the cool things that we have here at Evesham Mortgage is we have an app, right? So once we pre-approve a buyer, right? You refer me a loan. Once we pre-approve a buyer, that buyer gets their own app, right? And it's their own deal. And I update that app weekly. So if rates go from 5 to 5.25, I update the app to 5.25. So if that buyer goes and looks at a $500,000 house, all they do is they plug in $500,000. Their down payment's already there. The rate's already there. If there's mortgage insurance, that's already there. They change the purchase price and the taxes, and they get their exact payment. Right there. The realtor has the same exact app. So it takes all that guesswork out of it. And the other thing I'll say to every agent on here, if you have a listing and you get a pre-approval that's dated over 30 days ago, ask for an updated pre-approval, right? Because Brian, in the last 30 days, rates have gone up almost 3/4 point.
Easily,
so, if we're pre-approving somebody to their max and we pre-approved them at 4.25 and it's now 5.25, they're not going to qualify anymore. And the majority of the lenders aren't like us. They're not updating rates. They're not updating their pre-approvals. So you got to watch yourself, and if you have any buyers that you're working with and you've been working with them for 60, 90 days, they were probably pre-approved at 3 7/8. So you got to make sure that as an agent, you're managing your pipeline right now and doing it now before you get into an offer, before you get into a situation where you get a contract and all of a sudden the pre-approval from ABC Mortgage in California that they found online You get a call, they say, yeah, they don't approve anymore. And you have already ordered an appraisal. You've already done all that stuff. So you have to be vigilant now as a realtor. You guys, like, there's a lot of responsibility when you're in this kind of a rising interest rate environment.
Absolutely.
You guys see
Yeah.
it? Do you guys see anybody, real quick, Gene, because I know there's some questions in the chat, but do you guys see anybody buying points or buying down rates or anything like that? And how is that affecting a buyer? Like if they want to pay a point down, if they get the write off in taxes, stuff like that, or what, like you buy a point down, what does it actually mean in a mortgage rate?
Yeah, Rick, this is one of the notes that I jotted down before the call, just to talk about, what's now trending, right? Rick was talking about adjustable rate mortgages becoming more popular when we're in a rising interest rate environment. Now it's also buying a point. So for anybody that does not know, when you are trying to lock in an interest rate, you could pay an additional fee called a discount point to get a lower interest rate. It's basically paying a percentage of your loan amount to buy your rate down. Now, in a low interest rate environment, it's very rare you'll see somebody buy points because the spreads are really not worth the cost. But in a rising interest rate environment, you could pay 1% of your loan amount, and that could possibly buy your rate down a quarter to almost 0.375% off the posted rate. Sometimes maybe a half a point, sometimes. But in a regular low interest rate market, that 1 point might even drop your rate 0.1%. So you could double, almost triple, right, your value for paying for that point to buy the rate down. So yes, I have a lot more clients much more open to paying for the point. You just have to ask the proper question, right? Obviously, if you have somebody that's going to buy a home and they're out of there in 3 years, I'm not going to bring up a point because they're probably not going to be in the house long enough to make their money back, right? So Mr. Customer, you're better off taking the higher rate because you're never going to make your money back by the time you sell. But if you're a first timer or if you're a trade up buyer with a family and, through the application, I ask, how long are you going to be here? 10 plus years. Okay, well, let's look at paying points. Oh, I don't want to pay a point. Why would I do that? People have that weird, that weird vibe of paying a point. They think it's bad, but they don't realize that it's good when you use it correctly. So Mr. Customer, it's going to cost you X to save Y. You'll make your money back in 4 or 5 years. You're going to be there for 10 years. You'll be in the black for 5 years. So it might be, you might want to consider this. I've had some clients where I've actually had them put down less of a down payment to use that money to pay for another point. So They got an even lower rate, and it even showed them that their payment will be cheaper. So you put less towards the down payment and more towards buying a second point. Typically after 2 points, it doesn't really make sense, but sometimes that second point will. So rather than spending extra money, put 3,000 or 4,000 less towards your down payment, pay an extra point, right? Now we're back below, we're below 5% or mid 4, what have you. So points are super popular. It's trending back, and it makes financial sense for most.
Well,
That's all part of your closing costs, right?
Yeah, for sure. Due at closing. It's not due up front.
I just, and again, it comes down to working with the right people that actually know what they're doing, what they're talking about, that have the experience, same as working with, realtors that are working full time in this business, that's obviously the importance, and, having the right professionals around you. We got a couple of quick questions in the chat that's actually relevant to what we're talking about. Before I hop into that, we just wanted to obviously thank you guys for joining us every week here, Tuesdays at 11 with our Leaders Edge Network. It's open to everyone in any company that you guys work in. So if you guys find value in what you're hearing and seeing today, please tune in every week. We're here every Tuesday at 11, and invite a friend, send an invite to somebody else. But quick question we have from, Giselle says, we have a lot of new agents in the office that would like to see the calculations in black and white. So Rick was talking before, and Brian, you guys were talking about, calculating rates and, for example, knowing that if it's, a quarter of a point equals X amount of dollars, but, a lot of agents don't know these things. You guys are obviously the experts in this profession. This stuff is, you can spit this off the top of your head and, all these numbers, but, how can agents quickly calculate those amounts, and explain those things to their buyers? Maybe they don't want to, let's say they don't want to call you guys right away, so is there something that agents can be using? I'm sure there's, apps around or whatever.
Do we have like a chat or an email list of everybody on these calls?
Yeah, if you go into the chat right now, if you post anything, in fact, a couple people already asked, how can they get a hold of you guys? Because they.
Yeah, I'm sure Rick has it as well. I have a graphic that I actually posted on social media, and I've actually blasted out to all my realtors. Just a quick little graphic of buying then versus buying now and the amount of money that your payment has increased.
Right.
So I could shoot that out. I'm sure Rick's marketing team has something similar. Just a quick something you could hold on to on your inbox and just literally show a client, be like, look, here's what happened to your payment over the past X amount of months by waiting.
So
I could blast something out.
Yeah. So what you guys can do before this is done, actually, I want both of you guys go into the chat and just drop your, contact info in here. So if anyone does have questions, or they want to contact you guys about anything, they can shoot you an email or a text, and you can always share that information back, with them. Let's see. We have someone else that said, I had a client ask, what's the difference?
Gene, I'm sorry. What you just asked for, it goes back, like my app, you could go to the App Store and just put in Evesham Mortgage, and you could download that app directly to your phone, and you could do mortgage payments immediately.
Okay, so that's open to anybody, whether they're working with your company or not. They can download the app, they can play around with it.
Correct.
Okay. And you said the app was Evesham Mortgage?
Yeah,
in the App
just
Store?
go in the App Store and hit Evesham Mortgage, and you'll be able to download it to your phone.
Okay,
And if
perfect.
you don't want to do that, I just put my email in here. You could send me an email, say, Rick, send me the app, and I could send you the app directly.
Perfect. Another question we have for both of you guys, if you want to jump in and tackle. I had a client that asked, what's the difference between getting them pre-approved, let's say through their bank, and or a private lender, and if they both usually give the same rates?
Well, I mean, there's a big difference between a bank and what me and Brian do, right? What me and Brian do is we talk to the borrowers, we inform the borrowers what's going on, we stay with them through the entire process. We both have our own teams that handle everything. Even though I own Evesham Mortgage, I have an assistant, I have a junior LO, and I have a processor that work directly every time with every one of my files. So you'd always know that that's the person. Where you get a bank, you're going to talk to a different processor, and the LO might not even be available to talk to throughout the process. And then a lot of times banks will go from the loan comes in, the LO goes away, then it goes to a processor, then it goes to a manager, then it goes to an underwriter, and you don't have the simile of us doing everything. And then I go to every settlement that's possible, or I review the closing package with the person prior to settlement if they're going to have an attorney there. So that's a big difference between dealing with a bank and dealing with an independent mortgage banker like me and Brian.
Yeah, and again, one of the things that were brought up earlier, again, another note I jotted down was, in this environment, guys, the pre-approval used to be gold. You send out a pre-approval, your buyer would look for 4 or 5 homes, they'd find one, right? In this one, I'm urging and pressing my clients that get referred to me to go through the steps with my team to get pre-committed, which is basically getting the loan approved before you find a property. Rick touched upon it before. Not every lender is doing it. Not a lot of banks do it. Gab, I saw your message. Just because, and again, I work for a bank, so this is coming from experience. Just because they are so big, they can't operate as quickly as a smaller lender to get a client pre-committed fast enough so that they could put that offer on a house they want to buy against all other offers or buyers that are just pre-approved. That pre-commitment is going to give our buyers a competitive advantage over the other guys that are just pre-approved. Okay. And it's a negotiating chip. Like when I have clients that follow the process, I get my realtor on the phone and I say, look, they're now pre-committed. You got to sell speed, right? You got to sell speed. Evesham's doing it in 15 days. I tell them, get the listing agent on the phone. We're already approved. I just need title and an appraisal. We'll close in 2 weeks. Sell speed, right? Typically not something we do or we've done, right? Just because there was no need to, but now there is. So it's not even just the pre-approval is good. But we try to, combine forces and push them to get us their documents, to get them that pre-commitment, which has been working very well over the past, 24 months.
Yeah, guys, I mean, everybody that's on this call. So I personally use Brian. I personally use Rick. I've referred clients to both of them. Extremely, extremely professional. And both of these guys know everything there is to know about mortgages, right? So a lot of us will meet clients and they're like, oh no, I got a lender, or my aunt knows somebody over at TD Bank or whatever. I'm not saying that you have to push these guys on anyone, but there's no downside in them at least calling. So what I recommend, listen, just call Brian, just call Rick, just have a conversation. And then at least you can make an educated decision based on that conversation, because I've seen a lot of times where clients are using different mortgage guys and it's just not the same. And, this is not a time where you can afford to have any hiccups, because a hiccup can cost you a deal. So at least get them, say, listen, just appease me, call Brian, call Rick, just see what they have to say. If you still feel like you want to use, your aunt's friend, then by all means, go ahead. But I guarantee when they get off the phone with one of these two guys, it's going to help you and it's going to help them. Trust me. So it's just, at least, like I said, take their numbers and call them, because it's a big deal, unless you have somebody that you're married to using already and everybody, and it works good, but these guys are good. So just wanted to throw that out there.
Appreciate that, Christian. So, Gene, would you mind if I want to kind of inform everybody about, like, we're all looking for good referral sources, right? I mean, that's the big, where do we get our referral sources from? And I think there's one referral source that a lot of people miss out on, and it's financial planners, financial advisors. Because what does a financial advisor not want their client to do? Pay cash for a house, right? It's their job. What financial planner wants somebody calling them and saying, hey, I need $500,000 to go buy a house, right? So there's a program called delayed financing, and you could sell this to your financial planner, because if that person's going to buy cash for the house, they're going to do it anyway. Well, now you could sell your financial planner on this type of loan. They could pull the money from the financial planner, they could buy the house cash, and then we could do what we call delayed financing afterwards and reimburse that cash to them to go back into their back to the financial planner. It's a
refi, almost like a refi. Like, what is that? What it is?
It's a rate and term refi. Go up to 80%, and you just get the appraisal done, and it's an easy deal as long as that person was pre-approved first, right? So we don't want to. No mortgage person wants to have a realtor talk somebody out of cash. But think about the concept. You get that person, you go to that financial planner and say, hey, listen, they're going to pull the money anyway, but my lender will reimburse them up to 80% of what they pull out of there. And it doesn't hurt your sale in any way, shape, or form. It makes you look really, really intelligent, especially to the intelligent buyer that has that kind of money. And now that financial planner is really, really loyal to you. And it's a great program that not a lot of people use. It's very specific though, okay? It's got to be their cash. It can't be a gift. It can't be money from mom and dad. It has to be their cash, and that cash has to be traceable. So that's why I say one of our referral sources is a financial planner that most realtors don't even kind of talk to, because a lot of financial planners don't want to have that happen. But now you can go solicit it. Say, hey, your guy buys cash, and then we get it back to you.
Cool.
I have a question. So if he's buying cash, does that have to go back within like the 60 days so there's no tax load on that?
That would be it all depends on what the account is, right? And that would be where you kind of pull in the financial planner and maybe the accountant, and we all talk about what the turn time is going to be. And if it is 60 days, a guy like me and Brian, we'll get that done easily without any issues, right? But I'll tell you, if you have 10 lenders and you ask them about delayed financing, one is going to have any clue what it means, because it's nobody does it. Nobody does it. And in today's market, I'm doing it all the time, because honestly, most of these people don't want to pay cash. They don't want to take the money out of the market that's making the money, the market, but they have no choice. Well, now we're giving them a better choice.
Brian, on that pre-commitment, how long does that last?
That'll last. So the pre-commitment will be good for 60 days, which is basically how long a pay stub or a bank statement is good for. So, but to be clear, to update it though, Susan, all we would need, for example, if the commitment letter showed expiration date April 19th today, I would just have my team call the client, Mr. and Mrs. Customer, I need a pay stub or a bank statement, send it in. And then we just extended it out for 60 days without having to repull credit.
Okay. Because that would be their concern, because it is a pulled credit.
Well, one of the, that kind of brings me up to one of my points here. I feel like I talk about this all the time. It's kind of funny. Guys, when you're talking with clients, and Christian was, nice enough to say, to recommend myself or Rick, even if they're dealing with somebody to do their mortgage, it wouldn't hurt to give Brian a call or Rick a call. I know for a fact that you guys, the first thing you're going to say is, are they going to pull my credit? Because I don't want my credit to get damaged. So guys, here's the myth behind credit. Okay. Number one, your credit does not drop every time you pull. That's never been true. It's not true ever. Okay. Most people, I believe 75 to 80% of the clients I talk to are under the impression that every time you pull it, the score gets worse. Never been true. The only time your score gets worse is if it is pulled excessively in a 90-day period. And by excessive, we're talking like 15 to 20 times. So if they ever say to you, I don't want my credit pulled, ask the simple question. When was the last time it was pulled and how many times? My other lender pulled it once. Prior to that, it's been months. Your credit will not be damaged. It's never going to happen. Yeah. So that myth behind pulling credit and score gets worse has always been false, never been true. You don't want to pull it excessively, right? Excessive is as many times as I've said. 1, 3, 5, 6 times in 90 days will not have a negative impact on your score. The only thing that impacts your score is if you run a high bill on a credit card and then I pull it, you miss a payment, of course, so you run a bad debt. That's what affects your credit. So when you hear that response, feel free to tell them the fact that I just told you, that it does not get worse every time you pull it.
Thank you.
Yep.
Awesome. Hey, Rick and Brian, anything with, I know a lot of people are putting down less than, 20%. So how does PMI play into this whole role?
There's two different types of PMI, right? There's what we call single finance PMI and monthly PMI. And the PMI is a percentage based on the factors of the loan, down payment, credit score, type of property, and ratios. So every percentage is different. And there's different mortgage insurance companies. Like it is definitely something that if you have a lender, I have 5 different mortgage insurance companies. So every time I have mortgage insurance, I price it at all 5 and I give the borrower the best rate. And I mean, sometimes it's drastically different. One of the biggest things is the single finance. You can either finance it. So like let's say you're putting 15% down, you could finance it into the loan and you don't have anything monthly, right? Or you could do monthly. And that's another conversation that lenders like me and Brian will have with our borrower, because it's a big deal, right? So if the borrower, we ask the simple question, how long do you plan to stay in this house? Well, I'm going to be in this house for my lifetime. Well, then I'm going to advise that client on doing the single finance premium, because it's a lower premium, and but it doesn't come back to you. Where if we have a borrower that says, I'm only going to be here for 3 years, then I kind of talk to them to monthly, because then it'll be cheaper for them over the long haul if they're going to sell the house in 3 years. So mortgage insurance it's a game. Like you need an experienced lender to not just throw it out to the borrower, and you need the lender who's going to ask the good questions to make sure that the MI is the right MI for that borrower.
Yeah, you know what's scary? It's you just kind of hit the nail on the head, and again it comes down to, the clients and the buyers, not only just working with the right agents that are full-time professionals that do this for a living, but it also comes down to working with full-time mortgage professionals that understand, because the bottom line is, any of these buyers that are thinking about doing anything, if they don't understand it or if they're confused, they're not going to move forward. They're going to just keep taking the agents out, every weekend shopping for homes. And then when it comes down to it, they really don't understand what they're getting into until they actually talk to a professional to really understand, all the ins and outs. Real quick, I want to mention to both Brian and Rick, there's a lot of people that posted things into the chat that are looking for these graphics. So instead of you taking screenshots, when we're done, at the bottom right, there's like 3 little dots in that chat. If you actually click on the 3 little dots, then it says save the chat. So when we're done, if you save this chat, it'll download it to your phone, to your computer, and you'll have everybody's, information that asked for whatever they're asking. Okay.
I saw that. All right, that's a good idea. I'll get the graphic out as well. Gene, one of the chats talking about PMI, Pankaj had asked, isn't PMI makes higher if paying less than putting 20% down? So I was mentioning before, sometimes I'll have a client put down less money towards their down payment to pay for those points if they want that lower rate, right? And this is a really good question, because most people would say, well, if I'm putting 20% down, why would I put down less to pay the PMI just to get points, right? So PMI throughout the years, throughout my 20 years, has progressively gotten much more affordable, right? If you have good credit and you're putting down a decent amount of money, a decent amount, according to PMI companies, is 10%. So if you're putting down 20%, but you slide that down to 18%, yes, you will have PMI. However, with the extra money that you've just spent to buy that extra point, you are reducing your payment. Yes, you will pay the PMI. The PMI will be gone within 2 or 3 years because it's typically a conventional loan. So it's a really good question about why would I pay PMI? But a lot of times the PMI is so cheap, we're talking maybe $30 or $40 a month, but you're going to get this lower interest rate for 20 years, right? The PMI will be gone. So it's a valid question, Pankaj, and it's not for everybody, but there are multiple scenarios where dropping that down payment below 20% to pay that extra point in the long haul will save you more money. And that's something that I'll explain to a client, a particular client, on like an amortization schedule, where I'll type it up for them and I'll spit it out, and they'll actually see it in black and white how much they would have saved over the next like 20 years, right? So it's a solid question. I just wanted to bring that up, and it's not for everybody, right? But when it is the right product, and if I'm speaking to the right client, you know, it makes all the sense in the world sometimes to drop it down and pay the additional point for the rate.
Hey guys, let me ask you a question, Brian, maybe more geared towards you. A lot of clients will insist on using banks like Wells Fargo, Bank of America, Chase, just because they feel like, oh, they're the bigger banks, their rates are better, blah, blah, blah. So what are the advantages? And I see you smiling, Brian. But what are the advantages of using guys like you know, Rick, that you have your own company and you guys are smaller branches versus the big banks?
What a softball.
I mean, listen, I've known Christian for years, so that question just cost me a steak dinner because I told him to give me a nice lob wedge for me, so I appreciate that. Now, so yeah, look, to Christian's point, I was at a bank for 19 years, right? And you know, I've been talking to a lot of my agents when I made the move, and you know, I wanted to let them know why I was moving, and the big reasons were the amount of extra compliance banks have to do their job is so excessive. Because when you're a big bank, a lot, layman's terms here, guys, when you're a big bank, a lot of people want to sue you, right? Lack of a better term here. So you have a huge microscope on you when you're a big bank, which means that you can't just go from A to B like that. There has to be 3 or 4 levels before you can get there, which slow down the process. They started taking away products that I used for my clients that were beneficial. Costs were more and interest rates were not as competitive, right? So one of the main reasons I switched to a lender, you know, not a bank, was because of the flexibility, the speed in which I can operate, and the amount of products that I now have to offer. Those are the big to-dos. And I still have guys that work for me at Wells, and I hear what they're going through. And I know the compliance is a big factor that runs these big banks, which really makes a loan officer's job much more difficult.
Yeah, there's a lot of products out there now, guys and ladies, that everybody should kind of be interested in figuring out. There's no doc loans again. There's bank statement loans. There's what we call debt service loans, where if you have an investor who's buying an LLC, all we do is run their credit and get an appraisal. And if the comp rent on the appraisal covers the proposed monthly mortgage payment, they get the loan. And it's kind of easy to do. I've done a ton of those with investors. So there's a lot of different products out there. So if you have somebody that might have been pre-approved, you might have referred to somebody else, and they said, no, we can't do the loan, reach out to me and Brian. Let us see.
What are the rates on the no doc?
It's all dependent on FICO score. Like the one no doc program we have, it goes all the way down to 620 in credit score. And then it's a moving chart, Jesse. right? So 620 credit score, you need 13 months of reserves after your down payment, and that rate's probably going to be in the high sixes. You're going to be somewhere in the 6% range. But once again, the person that's coming for this no doc can't get a mortgage. So
Yeah, that's 1% better than I pay right now.
right. So I mean, but it all depends on when you get to that non-QM world. It's not like you can pick up the phone and call me and Brian and say, "Hey, what's your 30-year fixed rate on the non-QM world?" It's we got to send the loan out, and then they come back and they score it and they give us a rate, and it's that kind of thing. But you do it during the pre-approval stage. You don't do it, during after they buy a house.
Thank you, sir.
Very cool. Hey, so we're coming up toward our, we got about 9 minutes left. Does anyone have any questions they want to ask Brian or Rick? By the way, guys, thank you so much for getting on today. We actually had like over 90 people on the Zoom, which is awesome. And thank you everyone for tuning in and joining us. We're here every Tuesday at 11 o'clock. If you have a question, if you want to raise your hand or just unmute yourself.
Gene, I have a question. It's Maria.
Yeah, go ahead.
Yes, I recently closed a deal with Better Homes, and what they did is they offered cash, and they did the buyer's financing after the fact. Is that something that Brian and what's the other guy's name? Rick, do you have a program like that?
I do not have that cash buyer program to where they get cash and then they refi them after the fact. No.
So I've been hearing a lot of that. A lot of my realtors have been bringing that one up to me. Annie Mac is the name of the mortgage company. I know someone put that in the chat, where they're offering to pay for a customer's house for cash to remove that liability so that they can go buy a home and be non-contingent. I have a couple colleagues that work there. They've told me about the product. I don't know it intricately. I do know that it's a process, a very, very highly scrutinized process. I'm not knocking it because I'm sure it's going to work. I know it's a scrutinized process. I don't know the particulars. What I do know is my company, and it's funny, I was just at the Ventry team meeting, I think last week, and we were talking about this as well. My company is actually just rolling out a pilot similar to that. It's not in the Northeast yet. They never open up anything in the Northeast. They're always afraid. So they always start in like the Midwest, where it might be, a little bit calmer to kind of roll something big like that out. They actually did roll it out. It's in the beta stage where they're doing something similar to paying cash for the house. As I get more information and as it starts getting a little bit more weight to it, I will, maybe jump on another call with you guys. But Annie Mac is the only one doing it. They were certainly the pioneer of doing it. And I wish I could tell you more about it, but I haven't had anybody complete it yet, a client of a realtor. So I'm eagerly waiting. Also, I have some colleagues at Annie Mac. I'm waiting for them to get back to me on the process. Not one of them has actually happened yet, but they certainly, put themselves out there with it.
Yeah, one of the caveats with that product is Annie Mac's charging 3% up front in a fee. And if you do the refi with them, they give you 1.5% back. So there is a fee involved in that. And I 100% agree with everything Brian just said with regards to that program, because it's still not, there's a lot of big push of advertising. And I also have two people that work there and nobody's done it yet. So we're still trying to figure that one out.
Cool. Thanks.
Thanks.
And Pancash, we'll get you. Give me 1 second. You got your hand up. And, again, and Rick and Brian, it comes down to, I think you might have mentioned it earlier, somebody did, but a lot of times people don't realize, right, that they have other sources of funds, right, that they just forget about. A lot of people have, money sitting in a market, or their 401ks or whatever, things like that, where they can use that to their advantage, right, to be more competitive. But I think a lot of times they just forget about that. Am I correct, Brian?
They do. I mean, because when you buy a home, you have your money in your account saved up. Well, this is my buying a home bank account. This is it. Well, Mr. Customer, you're a first-time home buyer. You could get money from your 401k without paying a penalty if you show you're a first-time buyer. We supply a document for you to show to your 401k people that you are using this to buy a home, and that will avoid any penalties if you wanted to take that money out. especially for my clients that maybe aren't a first-time home buyer, but they know that as soon as they buy, they're going to sell. And let's face it, they could sell in a week. So I'll say, look, you might be able to pull the money out of your 401k, but you're going to replenish it in 60 days, right? You'll be able to put the money right back into that account because we all know you're working with a great realtor and you're going to get your house sold. So take the money out, put it right back in, right? That's, a lot of people don't. I mean, look, Gene, I've actually had clients, and this is not, the statistic sucks, but I mean, I got clients that are 8-9 months without a home. And I told them months ago, I'm like, look, you're sitting on a ton of equity, go get a home equity loan. While you're looking, go get a home equity loan. A few of them have done it. So now they went from 10% to like 25% down because now they have a home equity loan that they're going to draw from. And now they just increased their down payment and now they just crushed the competition where everybody else is at like 15 or 20%. And they said, screw it, I got this line of credit, I'll go to 25%. And now their offer was accepted because they had all this time and they had all this equity and the equity kept increasing. All right. Now, again, disclaimer, not every client can afford to carry 2 houses and a home equity loan, right? That's why, I do what I do on this side of the transaction. But for those clients that can, I've been pushing them, go use your equity, sit on it. Well, I don't want to take out more debt. You're not taking out debt. A line of credit, you don't start paying on it until you borrow from it. Just keep it open. They've done it, 50,000, 100 grand. Yep. And then 7 or 8 months later, they got a huge down payment, right? And they're going to sell that house after they buy and they'll pay it all off. So you just got
Brian.
Yeah.
I have a follow-up question on that one. I actually have a client that I've been suggesting that from like since last year. They're just like too scared right now because they might not find a home. And I know their house is going to sell in no time. Once it's in the market, of course they cannot take it, right? They have to take it before they put the house in the market.
Most home equity lenders do not want to see a house up for sale when they give out the money. Some will, most won't. So you're going to want to, even if you take the house off the market, you're not going to buy, you're not going to sell anyway, right? Because you want to look to see what you could buy first. Take it off the market, go get a home equity line of credit, leave it in the line, meaning don't spend any money on it, put the house back on the market.
All right. I think I might have to do that with this one. Okay, thank you.
Yep.
Hey, Pankaj, what's your question?
Thank you, Gene. I have a question for Rick. I know, Rick, you mentioned about, that you can check when you have a house, a buyer wants to buy a house and you have the address, you can appraise it and tell you can have appraisal waiver. As an agent, if I have a buyer who likes the house, all I have to do is I have to call you and give the address and you can tell me if it can be appraisal waiver. Is that what you mean?
As long as I've already pre-approved the buyer and I have all the buyer's information in and, I have their W-2s or pay stubs and stuff like that. I could just add the address and run it and see if we get appraisal waiver.
Okay. And that's something which is before he put an offer.
Correct.
Yeah, you definitely want to have that. That's kind of like that's your weapon, right? When you're putting your offer together. And real quick, I know we're not talking about this, but you just mentioned, offer. Everyone that's working with buyers, when you are formulating your offers, please put something together like, in like a formal email. Put something, put a little summary or a synopsis in your email, about you, about the buyer, about their qualifications, about the lender, who you're working with. That's just my recommendation to you, just to kind of, I don't know, give your offer a little substance and oomph. Please don't just send an email to the listing agent with a PDF attached of your offer and then just, wait for a callback. You got to do a little bit more. I hope that makes sense to everybody.
Yes, it actually helps also when you're the listing agent. When you're reviewing the contracts with your client, you want to know who they're working with and stuff like that. It really helps a lot.
It's more important now than ever. Our business has always been nothing else but all about relationships, right? And that's what it comes down to. So, I forgot whose tagline this is, but who you work with, matters. I see it all the time, and that's really the bottom line. Listen, it's 12 o'clock. We can't thank both of you guys enough for being on here today. We had, I don't know, probably close to 100 people on the Zoom, which is unbelievable. We'll be back on again next week, next Tuesday at 11. We ask you guys to tune in every week. Invite a friend next week.